Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, welcome to Technical Analysis Explained. I'll be your host, Tom Schneider, CMT with NinjaTrader. And with Technical Analysis Explained, we like to do a deeper dive into one of the technical analysis indicators or concepts that you might hear when you're trading, when you're reading about trading, when you're watching financial TV. You want to learn a little bit more about what they're talking about. We can do a deeper dive, like I said, and look at how this technical indicator might be calculated, why it's calculated that way, how to apply it to a chart, and where to use it, right? That's important too. How do you interpret that for different scenarios, if you will? So today is no different. We will be delving into the commodity channel index. Now, the commodity channel index is an oscillator, and it's like the other oscillators we've done on this show, where those oscillators show up at the bottom of the chart. Maybe we can go into the chart. We can just get right into it, take a look at what that looks like. And so if you have a chart up, you can just go to your right click and go to indicators, and you'll find CCI. That's the shortcut or the acronym for commodity channel index, and you can add it to your chart this way. Now, I've already added it to my chart. And what I like to do just to make sure it's calculating on each tick, because whether I'm on a daily chart or an intraday chart, I do want to see the most recent data because that'll help inform me what the market's doing. I also like to just remove the label. If it's the only indicator that I have underneath my chart, I know what it is. Just kind of the characteristics of the study, the fact it's an oscillator, and the scale, I can tell it's the CCI pretty quickly. And then I just hit OK. Just gives me a little bit of a cleaner chart. So what is the commodity channel index? Well, you see down here, it's this oscillator. And like other oscillators, it has extreme tops, it has extreme bottoms. And ideally, they occur near what's happening in the price. They reflect what's happening in price. Now, they're not going to be a mirror image of price, but in this case, it tries to reflect what's happening with extremes, meaning peaks and troughs, if you will. So what is the commodity channel index? Now, don't let the name deceive you, right? Commodities, you can apply this to any market. It doesn't have to be just commodities. Anything really that charts. Could be a stock, or it could be currencies or fixed income or an index. You can put commodity channel index on any one of these charts. So what is the commodity channel index? Well, to understand how it's calculated, we have to look at the price chart. And the price chart, I'm just going to zoom in so you can see a little bit better what I'm talking about. And let's focus in on this bar right here. And I'm going to bring up my crosshairs. I just go to this little arrow up here and turn on local. That'll give me my crosshairs. And I'm going to highlight this bar with my crosshairs. So right now it's in my crosshairs, and I'm using a bar chart. Normally I look at candlestick charts, but I'm using a bar chart to emphasize what goes into the commodity channel index. Commodity channel index uses something called the typical price. So understanding what the typical price is and why it's important is kind of the key to what the creator of this study, by the way, if I haven't said it already, Donald Lambert was the one who created this indicator, and it was published back almost, well, over 40 years ago, 1980, in a magazine, and that's where it kind of got its popularity, in a futures magazine. So the typical price is the high, the low, and the close. You take an average of that, a straight up average. So to find the typical price of this bar, I'm just going to highlight and click on it. I would take that high of 45.34.75, add it to the low 44.27.75, and also add the close 44.35.25, and then I would divide by 3, and somewhere between the high and the low I would get a value, and it would most likely be closer to the low than the high because that close is closer to the low. Now, why those 3 values? Well, any trader wants to know the range of trading on any given time period. In this case, we're looking at a daily chart. So this is the range of trading for that day. The high, 45.34.75, was the last price where there was no more trading above it on that day. For some reason, there were no buyers up there. You ran out of buyers. And then the low is where we ran out of sellers. Nobody wanted to sell below this low price of 44.27.75. So those are 2 important prices. And of course, where did the market close? Where did it finish for that bar, or that day in this case, because it's a daily chart? So those three values are very important. So what did Donald Lambert do? Well, he said, let's kind of take a typical price, an average of the 3, to get it a little more smooth, if you will. And let's actually take a moving average of that as well. So in this case, I have a 14-period CCI. Let me just double check. I believe my period is 14 on this. Right here, 14 periods. So we're looking back 14 periods. What that means is we're going to see how far the typical price, kind of this average price of the bar minus the open, how it travels away from the mean of the typical price. So we take a moving average of that typical price as well. So I don't have a study that does that. I don't have a study that puts on the typical price and the moving average of the typical price, but they're not going to be the same value every bar. There's some kind of gap between them, right? So if the market is trending down, I would expect that the typical price is trending down too. We're closing near lows. If we look at this downturn, a lot of times we're closing near the low, closing near the low, closing near the low. So that typical price is also moving down. And so the moving average would be moving down, but it probably wouldn't move down as much. So there's a gap. So when you start seeing the gap of the typical price and its moving average price extend to the downside because we're in a downtrend, we can try to capture that with this oscillator. Now that difference, it's not just a straight up difference. What Donald tried to do was take that median average, he takes the difference of the typical price and the average, and he takes an absolute value, takes an average of that. So basically what you're saying is how far we are between the typical price and the moving average versus on what is the average over time of that difference. And he actually multiplies it by a factor of 1 over 0.015 to keep that number readable, give us some numbers that are not decimalized. So the first thing I notice about this when I'm looking at it, though, it's unlike other oscillators in that it's not bounded. It's not trading between 0 and 100. We've seen that in stochastics. We've seen that in RSI. Those are great indicators because you can compare them across multiple asset classes. CCI doesn't have that indexing factor in place. So one thing to know that this oscillator is a little different from those other oscillators in that it's not bounded. Now, that just means for whatever markets you trade, you'll kind of have to get used to what that range is for that market. A lot of times you might hear, oh, well, 100 is good. Anything over 100 is overbought. And anything under negative 100 is oversold. And that might be true for some of the markets you look at. If I look at the E-mini right here, right now, the E-mini in a downtrend on a daily chart is negative 105. It's slightly oversold, and that kind of might be what we would expect. And if we put up an RSI or stochastics, we might see some oversold action going on as well with their readings. And if you look at this uptrend right here, during that uptrend, we got a little bit over 100. And okay, maybe it's overbought and it corrects. But that's the E-mini S&P. Let's see what happens when we change to the NASDAQ. So if I bring in the NASDAQ, and this is the micro NASDAQ future, you'll notice too, oh, look at this. Negative 200 might be a better place to say that this is overbought. Let me stretch this out a little bit so you can see this. So negative 100 was right here. We're barely getting into this trend, and you're printing a negative 100 on the micro NASDAQ. Maybe not oversold on the micro NASDAQ, but look what happens when we get to negative 200. We're in this trend. We're about 2/3 of the way. And we continue, we turn around. Maybe there's a better number. Maybe there's 250. This is where you as a trader would have to do a little bit of experimentation and see, where do these peaks and troughs happen on the study, and where do they happen in price? Now, an extreme might be, well, if you're thinking, oh, they're kind of in the same ballpark, let's take a look at natural gas. Natural gas trades at very different prices, right? E-mini trades in the 4,000s. NASDAQ trades in the 15,000s. Natural gas trades almost $3, right? So different scale. Look at this. Slightly different levels. Now, maybe negative 100 works here too. Maybe it isn't as volatile because it has been trending and has been basing. But you'll see that's a little bit different than the NASDAQ, and more resembles the E-mini S&P than the NASDAQ. So what I would suggest with the CCI, it can be a great indicator to try to find oversold and overbought areas, but you would have to be familiar with the levels that are important based on the market you're looking at. Now let's go back to an E-mini chart. I'll just type in ES and pull up the future, and there we are. We're back to a daily chart. Let's use 100 as our overbought and negative 100 as our oversold level. Now, that might be wrong. What are we doing? We're doing E-mini S&P. Maybe it's 200. Let's use 200. And what we can do is we can bring up a horizontal line, put it on the 200 mark just to make it a little bit easier to see. And we'll do it on the negative 200 level as well. Oops, I didn't redraw my horizontal line, so we'll do that again. And there we go. So now I've got my boundaries, and I can see possible overbought, possible oversold when we pop up above this 200 level. Well, what happened here? We were in an uptrend, and we were consolidating for so long. Just that little peak above brought us well above here, and then the turn down didn't last very long, but we did turn down for about 3 or 4 bars, maybe 4 bars, before we saw a turn up on the commodity channel index. Now, I wouldn't necessarily look at these as opportunities to buy or sell when it's in the middle of my 2 lines, but it could indicate a trend change that's somewhat subtle. You could look at this trend change and say, we're still range bound, and it's not until we get above these highs we say, oh, wait a minute, this was really a trend change. Well, it's too late, right? That horse has left the barn. So, I'm looking at these peaks and these valleys to help me identify where there might be turnarounds. Let's take a look at the weekly. The weekly, same concept applies here. We've got a 200 up here. We've got a negative 200 down here. And are we considered overbought, oversold? It's your judge, right? If we go back to the pandemic, we can see that we got above 200 for quite a while, and that market kept going. But that was after a pretty nice run, right? And then we saw the big sell-off in March and February and March. and then the rise here when we were below negative 200. So these levels on the commodity channel index, depending on the market, can help you with being overbought, oversold. You can also look at CCI on an intraday chart. Intraday chart is no different. It's just a matter of where those levels work for the market you're looking at. I see a lot of activity, rarely, but it does get up to 206, 200, 206, maybe a little higher, maybe a little to 210. But it looks like on a 10-minute chart, if you would use the 200 level as an overbought level, and when it crosses back below, that might have been a good area to sell. Now, does that mean you hold it? How long do you hold it? Well, there are other indicators you can use. You can use, if you're in and out of the market pretty quickly, that might have been something you use a time target, right? I want to be out of here in an hour. I want to have a profit target of so many ticks. Or you can use other indicators to say what your profit target is, but the CCI can help you with those exits and entries as well. Here we see when the market did retrace back up here, it rallied a little bit. When it got up to 200 again, there was a big move down. So this 200 extreme overbought level might be a key when you're in a 10-minute chart that the market is retracing. Similarly, when you're down here at negative 200, it looks like a pretty good area that there might be a return to the upside. It's like a rubber band that gets stretched, or this market is getting too extended and it wants to get back into this negative 200 to 200 area. So using the CCI with overbought and oversold levels, you just have to know what those levels are. And how can you learn? Well, you can look online and you can see what other traders might use. You can look at other charts online, see what other people are using for the markets that they trade, or you can experiment yourself. Sometimes it's just as easy as putting the chart on, the study on the chart that you're trading and say, okay, well, where are the extremes and where did the turns happen pretty reliably? Now, it's not always going to catch a turn, right? Look at this. We got on the CCI, we got 265. That's pretty extreme. We were still in a downtrend. Now, the market continued, but the CCI did pop up above 200. So it wasn't a case where the CCI was accurate in providing, reversal details. And that's going to happen. This is why we don't use indicators in a vacuum, by the way. We want to make sure that we have something else that might give us some insight as to why this might not have happened, right? Could be a Bollinger Band. It could be another oscillator. Sometimes it's good to have different types of oscillators. I wouldn't want 5 oscillators on the same chart, but you might use a bound and unbound oscillator measuring momentum, and they measure them differently. And when they're in alignment, that might provide a more secure, or you might feel secure and confident in making a decision when indicators are in alignment. Now, what else can you do with this? Well, we know about the overbought, oversold levels. Maybe you just want to know when it's overbought and oversold. You just have to know those levels for that market. And maybe you want to use those overbought, oversold levels as actual triggers or signals. Not that when it gets above that overbought level or below that oversold level, but when it gets back into the neutral area, when it's kind of run out of being in that overbought or oversold area, that might be a case where you take that trade. That would be a trigger. Okay, that's fine. But another way, like a lot of oscillators, we can look for divergence. There's a great divergence on the daily chart. So I'm looking at daily E-mini S&P. This is an old trend line. I'm going to get rid of that. And recently, there was an interesting, I'm going to go a little more recent, where we had a nice uptrend in the E-mini S&P since about March 13th. And what I would expect when we're in an uptrend, you can ignore where we went sideways here. but I see uptrend from March 13th with a bit of a pause through May. May resumed up until the end of July. We had this nice uptrend. And you can see we pretty much, it's not a straight uptrend, right? We make a new high, we pull back. We make a new high, we pull back. We make a new high. And you see there's these like successive highs that are a little bit higher maybe, or at least the same amount, right? We pull back, we make a new high, a little bit of a pullback, we make a new high. Well, what's happening on the indicator? Not making new highs, right? You can see successive lower highs. So if I were to draw an ellipse, and I'm going to circle, let's see if I can do this easily. I'm going to do a bunch of copies of this, and I'm just going to move them where I see these kind of successive highs. And let's see if I can do this easily. It's not always when you're scrunched up in the panel here, it's not easy, but we can do it, right? We can move this over. There we go. And except for this one, which is a little out of whack, I'm seeing these highs are declining, right? Whereas these highs are increasing. When I see, especially on an unbounded study, we can't make higher highs, or our peak highs aren't outperforming the previous peak high, then that tells me that there's some weakening in the momentum. And what happens? We see, this huge move up here, right? And this peak high is just so much lower than everything else. It's not a surprise when the market turns down. And you can do that on the bottom as well. So in a downtrend, and we might have to go a little bit back to find one. We have to go back to 2022. When you start to see lower peak lows and you start to see higher peak lows, if peak is the right term, maybe it's troughs, lower troughs on the price, but they start to turn around here. That's the momentum telling us that maybe this market wants to turn up. And it isn't always a perfect divergence, but this was pretty obvious when this just couldn't get above that 200 level that we might have identified as overbought, and those highs were declining as the prices were going higher. Not a surprise that not too far after that, when we make this really low peak high, this market turns. So with commodity channel index, very interesting oscillator. You can Google it. You can go to your favorite search engine and learn more about it. But basically, it's just another way of measuring whether the momentum in the trend is continuing or if there's maybe a turnaround coming. And it uses the typical price, like we said, the high, the low, the close, the average of those three values, and its distance from the mean to determine if this trend is accelerating, decelerating, turning around. There's an opportunity. And we can use that also for divergence purposes, kind of like we do with other indicators, but it's been around for 40 years. Don't let the name fool you. Commodity channel index could be used on stock index futures, currency futures, bond futures, and it's readily available as the CCI in the NinjaTrader 8 platform that you see here. So with that, I'm going to end the show. I hope you got a lot out of this, and this will probably be the last show on oscillators that we'll have for a little bit. We're going to look at some other concepts and other tools that we use that we have at our disposal for other purposes. And then we might get even into some more in-depth ways or variations of some of these basic oscillators that we've seen in the last couple of months. I hope you enjoyed this. Remember to follow us on YouTube, to go to our ninjatrader.com/learn page. We can find the videos at ninjatrader.com/events. If you have a question about this show or any of the other shows, send an email to learn@ninjatrader.com. And someone here, if it's not me, it'll be Jim or Mike or the Mission Control folks. We'll take a look, see if we can answer your questions. And don't forget to watch our bookend shows, The Opening Range and Bars Closing. And in the meantime, I want to wish everybody a great trading day. Take care.